Okay, let's dive right into this because something huge just happened in the world of stock trading. A rule that's been on the books for more than 20 years has just been wiped off the map. Seriously, for millions of people, the market just swung its doors wide open, and we're going to break down exactly what that means for you.
So that's the big question, right? Why did the stock market suddenly become accessible to so many more people? It felt like it happened overnight, and believe me, it is a fundamental ground level shift in how active trading works in the US. To really get why this is such a massive deal, we gotta first look at the old rule that just got tossed out.
For a long, long time, there was this massive gatekeeper, kind of like a bouncer, standing between the average person and the world of day trading. And it all revolved around one very specific, very strict label.
And that label was the pattern day trader, or PDT for short. Now, if you made four or more day trades, that's just buying and then selling the same stock on the same day within a 5-day window, bam, you got flagged. And the second that happened, you were suddenly playing a whole different ballgame with a really steep price of admission. And this was the magic number. $25,000. If you wanted to be a pattern day trader without getting your account locked down, you had to keep at least 25 grand in your account at all times. If you dipped below that even for a minute, you were frozen out of day trading. It was a hard, immovable wall for so many people. Now look, this rule didn't just appear out of nowhere. It was actually born from the ashes of the dot-com crash. Back in 2001, regulators saw countless everyday investors get completely wiped out. So FINRA created the PDT rule, thinking of it as a protective measure, a financial cushion, to make sure only people with serious skin in the game could trade that actively. But now, more than 2 decades later, that entire era is officially over.
Which brings us to today. The gatekeeper's gone, the wall is down, and a completely new way of thinking is in place. This is the turning point, for real.
So on April 14th, 2026, the SEC gave the final nod to a proposal to completely scrap the pattern day trader rule. The 25K minimum, gone. The annoying trade counting, gone. The PDT label itself, all of it just eliminated. And the market's reaction? It was immediate. You saw retail brokerage stocks like Robinhood and Webull just pop. And you have to ask why, right? Well, it's simple. Their potential market of customers just exploded. All those traders with smaller accounts were suddenly back in the game. So what took the old rule's place? This wasn't just some minor adjustment. No, this is a whole new philosophy on how to manage risk in the market. I mean, the difference between the old way and the new way is night and day. The old system was, well, it was a blunt instrument. It didn't care if you were trading a super safe stock or a crazy volatile one. It just counted your trades. The new system is way smarter. It's dynamic. It completely ignores how many trades you make and instead focuses on what actually matters. How much risk are you really taking on at this very moment? So let's break that down into simple steps. First off, the label pattern day trader, it's history. Forget about it. Second, you can finally stop counting your trades like you're on a ration. And third, this is the big one. Your buying power is now all about something called intraday margin. It's based on the real-time risk of your portfolio, not some old static number. And the biggest knock-on effect of all this is pretty powerful, actually. It's the true democratization of trading strategies that for decades were pretty much just for the wealthy. And this number, man, this number puts it all into perspective. The average account size at a major broker like Webull is about $5,000. Just look at that gap. The old $25,000 rule basically told the vast majority of their own customers, nope, you can't play. This change finally closes that gap. And hey, don't just take my word for it. Webull's CEO, Anthony Denier, said it himself. He said this is all about opening up the markets for smaller customers. The argument here is that the old rule was never really about managing risk. It was more about keeping people with less capital out. This new system finally levels the playing field. But of course, with more freedom comes, well, you know how it goes, more responsibility. Tearing down those old guardrails introduces a whole new set of risks that every single trader needs to understand. And here is the other side of that coin, perfectly put by Ophir Gottlieb at Capital Market Labs. He points out that this new freedom could just make it easier for people to take more of those high-risk YOLO shots. And you gotta remember, the freedom to trade more often is also, quite simply, the freedom to lose money faster. So the crucial takeaway here is that the responsibility has shifted. It's now squarely on your shoulders. You are your own risk manager now. And while the old penalties are gone, there are new ones. If you can't meet a margin call during the day, they can freeze your account for 90 days. So yeah, the system is more flexible, but it is definitely not without teeth. So, with the floodgates open and the rules rewritten, what does this all boil down to for you?
Well, the way to think about it is this. The regulatory big brother that was constantly counting your trades over your shoulder, he's gone. But in his place, your brokerage is now watching your actual risk in real time. The oversight is smarter, it's faster, and it's tailored specifically to what you are doing right now. And that really leaves us with the ultimate question, doesn't it? The barriers are down, access has been opened up for everyone. But is this new freedom going to create a whole new generation of smart, savvy retail traders, or did we just invent a much faster, more efficient way for people to lose their money? The answer, I guess, is gonna unfold in the charts, one trade at a time.